Welcome to World Knowledge. When the US dollar weakens, its effects extend beyond the US economy to the rest of the world. A weakening dollar can cause major changes in the world economy, affecting international trade, investment flows, and the financial health of other countries. This change can increase the prices of goods exported from other countries, affect the cost of imports, and alter the trade balance between countries. Let's explore the specific consequences of a weakening dollar on the global economy and how countries can adjust to deal with these changes. For countries that rely on imported goods, a weaker dollar means they have to pay less for essential goods. This can help reduce overall inflation in those economies. The dollar index, which measures the U.S. currency against 6 major currencies, is on track to fall 3.7% in November 2023, its worst month of the year for the greenback. The decline in the dollar, the world's most widely used currency, is good news for countries that rely on imports and those that pay off debt in the currency. But it may not be so good news for U.S. businesses and consumers. The dollar index has risen more than 7% since mid-July through early October 2023, buoyed by a series of positive economic data from the U.S. economy, fueling expectations that the Federal Reserve will keep interest rates high for a while longer. USD heads for biggest monthly loss in a year. On November 30, the dollar index, a gauge of the greenback's performance against a basket of major currencies, fell 0.058% to 102.74, nearing 102.46, its lowest since August 10, recorded in the previous session. Higher interest rates tend to boost the value of a currency by attracting more foreign capital into the country, as investors anticipate higher returns, increasing demand for the currency. However, in recent weeks, the U.S. economy has shown some signs of slowing down. Markets are increasingly betting that the Fed is nearing the end of its rate hike cycle and will soon start cutting rates. The dollar is likely to weaken for another 2 quarters, especially as the Fed's rate-cutting bias becomes clearer, said Ulrich Leuchtmann, head of FX research at Commerzbank. Cameron Willard, from the UK capital markets team at Swedish bank Handelsbanken, also believes the dollar will continue to weaken in the first half of 2024. But he added that the greenback's value could reverse later next year due to geopolitical risks, such as uncertainty around the outcome of elections in some countries. For countries that rely on imported goods, a weaker dollar means they have to pay less for essential goods, such as wheat and crude oil. This could help reduce overall inflation in those economies. Although a weaker domestic currency is seen as a disadvantage for U.S. businesses and consumers. But U.S. exporters will also benefit, says Mark McCormick, head of Global Foreign Exchange and Emerging Markets Strategy at TD Securities. As their prices fall, their goods become more competitive abroad. At the same time, a lower dollar will increase the cost of imports into the U.S., giving domestic companies a competitive advantage over higher-priced imports. That's also good news for emerging markets. Some developing economies have foreign debt denominated in dollars. A weaker dollar will make it less expensive for them to repay those debts. McCormick said the falling value of the greenback also signals better investment opportunities outside the United States. A weaker dollar will create a ripple effect that will encourage investors to go global, he said. But that's not good news for American consumers. As the dollar falls, they pay more for imported goods and vacations abroad. A weaker dollar essentially makes the United States a little poorer, because they have to pay more for the goods they import and get less for the goods they export, Leuchtman said. He noted that, all else being equal, a sustained, rapid decline in the dollar could potentially cause inflation due to rising commodity prices. However, the inflation scenario depends on many factors beyond prices. Willard pointed out that the U.S. labor and housing markets are cooling. These two factors are likely to keep inflation in check, even as import prices rise. I don't think the Fed is going to be overly concerned at this stage, he said. The weakening of the U.S. dollar has far-reaching implications for the global economy. While exporting countries may benefit from increased competitiveness due to a weaker currency, importing countries face higher costs for goods and services. This shift could also lead to a shift in international capital flows, increasing volatility in financial markets and potentially destabilizing emerging economies. For businesses and investors, it is important to adjust strategies and reassess risk factors. Central banks and governments will need to take policy measures to stabilize the economy and protect sustainable growth. In short, the weakening of the dollar is not only a problem for the U.S. economy but also an important factor affecting the global economic structure. The U.S. dollar is unlikely to be dethroned as the world's dominant currency, according to Morgan Stanley. Although many other currencies are trying to increase their influence in the global market, the U.S. dollar still maintains its position as the world's dominant currency. According to Morgan Stanley, the strength of the U.S. dollar is unlikely to change easily, even with increased competition from other currencies and fluctuations in the global economy. The stability of the dollar comes not only from the size of the U.S. economy but also from the global financial system and capital markets in which the USD dominates. Let's explore why the dollar still maintains its dominance and what factors are contributing to its superiority in the international arena. Morgan Stanley raised concerns that the U.S. dollar could eventually lose its status as the world's most widely used and held currency, Business Insider reported. Rivals to the greenback such as the Chinese yuan, the Japanese yen, or even the BRICS currency bloc could disrupt the dollar's statistics. But there are three reasons why the dollar's dominance won't disappear anytime soon, Morgan Stanley strategist said. China's yuan not liquid enough to challenge the dollar. Morgan Stanley strategists say China's yuan is not liquid enough to truly break the greenback's dominance. That's partly due to China's tight capital controls on its currency, which limit the amount of cash that can be brought in and out of the country. It seems unlikely that the yuan will challenge the dollar anytime soon. To do so, we think China will need to loosen its currency controls and open up its capital account. It seems unlikely that Beijing will want to do this anytime soon, said James Lord, a strategist at Morgan Stanley. As we know, questions also arise for the Chinese economy, as consumer demand declines and the country's ongoing real estate crisis. U.S. debt concerns won't hurt the dollar. Doomsayers say that confidence in the greenback is waning amid concerns about the growing U.S. debt. As of this year, the U.S. government has accumulated more than $34 trillion in debt, a record. However, that has had little impact on confidence in the dollar, given its long-standing reputation as a safe haven with high liquidity. Morgan Stanley strategist Michael Zezas said, "I understand the concerns, but in the near term, it doesn't matter much. Depending on the U.S. election results, there are some fiscal expansion measures is on the table, but in our view it is not too big, and unless the Fed fails to fight inflation, which is unlikely, the dollar is unlikely to become a volatile currency. Inflation has cooled significantly from its 2022 peak, despite pandemic-era spending and rising debt levels. According to the latest inflation report, consumer prices rose by just 3.5% in March, down from a peak of 9.1% a few years ago. And cryptocurrencies are not a viable alternative. We can see that. Strategists say that while cryptocurrencies like Bitcoin are highly liquid, they are too volatile to be considered a real alternative to the dollar. Other economists have also dismissed the possibility that the dollar will be overthrown from its dominant position anytime soon. Economists have previously told Business Insider that the replacement of a dominant currency is something that happens over decades because it takes time for people to switch to other currencies after a dominant one is recognized as a safe haven. Despite growing competition from other currencies and global economic volatility, the US dollar has maintained its dominance thanks to a number of fundamental factors. The stability of the U.S. economy, the size of the world's largest financial market, and the USD's key role in international trade transactions and global foreign exchange reserves have reinforced its position. Morgan Stanley Bank pointed out that the strength of the dollar is not easily undermined by alternative currencies, thanks to the USD's continued role in shaping global financial policy and maintaining investor confidence. Amidst global market uncertainty and political and economic turmoil, the dollar continues to be a safe haven for investors. In short, the dominance of the dollar is not only a reflection of the current strength of the U.S. economy, but also a result of a combination of historical, economic, and financial factors. The dollar remains central to the global financial system, suggesting that a change in its position will not be easy and that a major shift in the global economy is needed to shake this throne. If you find the video useful, please subscribe to the channel. Like and have any questions, please leave a comment below. Thank you for watching.